many different places across the country and here in central Iowa. We are really excited to have today's presenters, Andy Russo and Kristen Schmidt from the Charitable Trust Administration Company in Cleveland, Ohio. And as I understand, their weather isn't nearly as nice as central Iowa, so I just have to plug that it's really going to be nice here today. We're excited. So today, Kristen and Andy are going to talk about CGAs and CRTs and the basics of these planned giving vehicles. It should be a really informative and I think exciting topic to hear about. As I've said in many of our webinars and in face-to-face conversations with many of you, planned giving is not a monster in the closet. You need to open the door because there are a lot of very basic tools that you could be using to dip your toes into that planned giving arena and really make a big difference with your nonprofit. So today's presentation is going to help you have a better understanding of just two of those tools that you could use to get started in that planned giving market. I'd like to introduce our speakers to you today. Andy Russo is the president, CEO, and co-founder of CTAC, the nationally renowned third-party charitable administration service corporation, founded in 1995, and again, it's located in Cleveland, Ohio. Andy has worked with many industry leaders to provide solutions for very complex tax issues that have been implemented and then taught at national conferences. His comprehensive experience is a valuable asset, combining knowledge of charitable tax law, IRS codes, regulations, and investment complications on all types of charitable entities. Many have benefited from his capability to very quickly analyze and implement strategic planning and to recognize the opportunity that planned giving can offer to charitable organizations like many of you are with. Andy also volunteers his expertise on several national foundations and with boards in the northern Ohio area. He's a member of the Partnership for Philanthropic Planning as well as the Northern Ohio Planned Giving Council. Kristen Schmidt is the marketing coordinator for Charitable Trust Administration Company, and she's been a member of the Northern Ohio Planned Giving Council since 2010. And this past June, she joined their board of trustees, and she is the co-chair for their annual conference. That takes place in May. Other organizations that Kristen is a member of include AFP and the Lake Health Foundation Planned Giving Professional Council. Kristen has her undergraduate degree at Baldwin Wallace University and is currently finishing up her Master of Education in Adult Learning and Development at Cleveland State University. Without further ado, let me give you Andy and Kristen. And just a quick reminder, we will hold all questions to the end of the presentation, so if something comes up during the presentation, go ahead, type it in, and when we're done, we'll get back to all of the questions at one time. Enjoy.
Thank you, Sue, for that nice introduction of us. We're glad to be here, and it is much nicer in Iowa than it is in Cleveland right now, but we're catching up hopefully soon. What we're going to be talking about today is charitable gift annuities and CRTs, just a very basic version of it, to get a little bit better of an understanding. And the first part of it is just going to be basically what a charitable gift annuity is and how it works. Basically what it is one or two donors. Usually the donors will end up being your annuitant, but there can be one or two donors that give the gift annuity to another annuitant or annuitants, a maximum of two. And what they do is they give a gift annuity. They establish a gift annuity with the charity, and the gift becomes a part of the charity's asset, and then payments are made to the annuitants for their lifetime. Once the annuity is given, it's backed by all of the charity's assets, and it becomes property of the charity. Once the gift annuity matures, the remainder of the gift annuity goes to your organization, and with CGA rates, they usually expect about 50% of the gift to go to the charity. Talking about the American Council of Gift Annuities, what they do is they provide suggested charitable gift annuity rates for nonprofits and donors that for, I'd say, most part, if not all of our organizations do follow the American Council on Gift Annuity rates. The only exception to that is when someone wants a payout rate that is lower than the American Council on Gift Annuity rate, and that reason being would be just that they want the charity to receive more of the funds. The only thing that we caution when someone chooses to do that, to go lower than the American Council Gift Annuity rate, is that to sign a form saying that they understand that they are taking a payout rate that is lower than what the American Council on Gift Annuities recommends. And when you set up a gift annuity, you are going to have, there's 3 versions of an agreement that you can have. You're either going to have a single life agreement, which is just a gift annuity for payments for 1 gift annuitant. You can have 2 lives in succession. What that means is just the annuitant, the agreement is made to the first person, and then if person number 2 lives longer than person number 1, then person number 2 is then paid from the gift annuity. And then what the joint and survivor is that is when the annuity is paid to 2 people simultaneously. When the one annuitant passes away, the survivor is then paid the entire annuity amount. Again, talking about CGA agreements, you can either have an immediate gift annuity, a deferred gift annuity, or a flexible gift annuity. And immediate, the gift annuity just starts immediately, the payments begin. Deferred is when an annuitant chooses to receive payments at a chosen date at least 1 year after the contribution. So typically gift annuitants are 65 years old and older. If you have someone that's in their 40s or 50s and is interested in a gift annuity, what they could do is they could set up a deferred gift annuity, and their payout will be later. And then also what you have is a flexible gift annuity. Donors don't have to choose a payment right away. What they can do is they can choose to have a payment starting at a later date. And in your agreement, you have to follow certain disclosure language. So I just put a few up here. They're all very similar, but you'll see that they're slightly different. There's different softwares that you can purchase to create your gift annuity agreements for you that will automatically follow all of the state regulations. It'll automatically put in the correct gift annuity sample disclosure language, and it'll automatically format the gift annuity agreement how the specific state wants to see it, so you don't really have to worry about it. And talking about state regulations, they vary from state to state, and it's very important that you're in compliance with the state regulations. If you go to the ACGA website, what they'll do is they will give you some background on the various regulations. So there's 4 types. You have states that you either need to initially register or notify, and you must also file an annual report. There's states that are conditional exemption states where you just have to meet certain criteria. There's states that you just have to notify them once and then you never have to talk to them again. And then the last is the silent states. Those are your easy states. They don't govern any rules with gift annuities. And if you come here, you can just click on the different states and they will show you what's required of it. For example, in Iowa, if you were interested in having a gift annuity, starting a gift annuity program, your organization would have to be in operation for at least 3 years, and your minimum assets would have to be $300,000 or 5 times the face value of total outstanding gift annuities in unrestricted cash, cash equivalents, publicly traded securities. And here are the states that require initial notification or registration, and you must file an annual report with them once a year. You can usually go to the state's website, and they will tell you exactly what the registration is, what you need to submit for registration, and also give you your form for filing annually. Some of them just simply want you to send in your audited financials every year. Others sometimes want to see a little bit more detail. And then here are our states that certain criteria must be met, but you do not have to notify or speak with the states about it. You do not have to register or notify them. And we also have our silent states that don't really govern gift annuities. So if you think you're interested in starting a gift annuity program, something that you should consider would be the history of your organization. You want to think about your current donor base and see what their ages are. As I said before, 65 years old is usually the minimum age for starting a gift annuity. Do you currently have a list of current and loyal donors, that's where I would start with marketing, is your donors that have been giving annually for the past 5 or 10 years that are the right age bracket would be a good one to start with, and then you can expand it further on. And then you also want to know if your donors trust in your organization and do they believe that you're going to be around in 20 years. Because if they have a gift annuity with you, you're responsible for paying them income for their life. So if they don't have trust in your organization, your financials, it's going to be hard to talk to them about a gift annuity. You're also going to want to think about your financials. For certain states, they have different minimum criteria. Iowa, we saw was $300,000. If you're in Idaho or Missouri, I think we have some folks on the phone from there as well. They are actually only $100,000 in minimum assets. And you're going to want to ask yourself questions for, do you have finances that are going to support the charitable gift annuity payments to donors? Do you have staff in place to run your gift annuity program and to do your marketing and to do your donor stewardship? Then moving on to development, you're going to want to think about your donor profiles that we talked about a little bit before. Are you currently cultivating and soliciting new and existing donors? Are you already recognizing and providing good donor stewardship to donors throughout the years? If you're already doing these things, it's making yourself a lot easier to set up a gift annuity program. Thinking about your staff, do you have development management in place? Do you have fundraisers? Do you have administration support that you can count on? And if you already have a planned giving program, how is your bequest and giving society set up? Because that's what you're going to want to capitalize on. That's where your target market is going to start with, is if you already have a bequest society. And then certain guidelines that you should have in place when you want to start a gift annuity program. Gift annuity resolution, gift acceptance policy, resolution regarding reserve funds, a gift annuity procedures document, a gift annuity application, your gift annuity agreement, and a disclosure statement. If you go to here's a sample of a gift annuity application that Sue and I actually worked on for a nonprofit organization, and we completely customized it. But you'll see on here, we want to know if the gift's immediate or deferred. If it's deferred, how old does the annuitant want to be at their first payment date? Again, it's probably going to be 65 years or older. You're going to need to capture your donor information, the annuitant information in case it's different than the donor. If, for example, if it's a husband that's the donor and wants to set this up for his wife, the husband would be the donor and the wife would be the annuitant. And then here is the information about your gift that you're going to be making. Coming down here further is your payment frequency that your donor wants to receive. Is it quarterly, semi-annually, annually? And what we're going to need is a copy of a voided check so that we can make ACH payments directly into their bank account. And then down here, the donor signature. And then for a disclosure statement, CGA actually gives an example disclosure statement. If you go to their website, under gift annuities and sample gift annuity disclosure statement, so it gives you a starting point that just states some of the information that you're going to want to have in there. If you go to the ACGA website, they do provide you with a lot of information, and they want your organization to be successful with gift annuities, and they're also always very helpful if you ever have a question to just call or email them. They actually have a conference coming up as well in April that I believe Sue and I both are going to be at. So once you have all of your policies established, then you're finally going to get a new CGA, and you're going to have people that are interested in setting up a gift annuity. So what you are going to be doing, items that you're going to have to worry about are preparing the application, which I already showed you, preparing a gift annuity illustration, which is basically just a sample of what the gift annuity is going to look like for the donor. It's going to have their age, their payout rate, the payments that they can expect. What you're going to provide to the donor is you're going to want to give them a cover letter. You're going to request a copy of the donor's ID. It usually doesn't happen, but sometimes donors may accidentally or not accidentally give you the wrong age. We need to verify their correct age, so usually a driver's license is the easiest. You're going to give them a copy of that CGA application, an illustration, your disclosure statement, and a return address envelope if you're mailing all of this to them. Then once the donor sends it back to you, you're going to review the materials and get from the donor, and then you're going to send the donor your summary and taxation sheet, which just explains to the donor exactly how the taxes are going to work and what they can expect. It's included inside the illustration, so what you would do is you would just rerun the illustration on the date that the gift was actually made. You're going to give a tax acknowledgement letter, Philanthropy Protection Act. You're going to provide them with 2 CGA agreements. There's a Form 8283, and again, a return address envelope. And this is if you're not doing the gift in person with the donor. For example, if you are in Iowa and you are getting a gift from someone that's in Ohio, then it would be done this way. Once you receive these materials back from the donor, you're going to review them and send a thank you letter. And then you would prepare a donor folder that has all of this information in it. You can do physical as well as an electronic folder. Then you get into the administration of the gift once you finally have the gift, and you are going to be responsible for processing distributions. Payment cycles are usually monthly, quarterly, semi-annually, and annual. I personally wouldn't recommend monthly payments for smaller gift annuities because it's not going to be that large of a payout and it might become too cumbersome. So we typically do quarterly, semi-annual, or annual payments. And when you're sending these distributions out to your donors, whether it is electronically ACH'd into their bank account or if you're sending them a physical check, this is a great opportunity to reach out and speak with your donors because this is going to be one envelope that they're most likely going to open. So what we recommend to our clients is we recommend that they include some kind of stuffer in their distribution letters or in their distributions and just tell them what's going on with the organization, how their gifts are making a difference, if there's an upcoming event that you want to invite them to. This is something that you can almost guarantee they're going to read. So these are great opportunities to connect with them. And something else that we also recommend that our clients do and our clients request from us is birthday reports. Once a year, they want to know, they want to list all the birthdays that are coming up, and then that's an opportunity for them to make a quick donor phone call, or if you're going to visit them or send a birthday card, whatever they want to do. That's another great way to stay in contact with them. You're going to be responsible for providing your annuitants with a 1099, and then you're going to be responsible for providing the IRS with a Form 1096. The 1099s are due to annuitants by January 31st of every year, and for your 1096, if it's filed electronically, that's going to be due by the end of March. And if a donor has multiple gift annuities with your organization, which is likely if you are providing good donor stewardship and you're staying in contact with your donors, they're likely to make a gift again in the future, you can combine all of those gift annuities onto one 1099. Then we have our Financial Accounting Standards Board, or our FASB report. And at the end of the fiscal year, the FASB report must be generated. And what this is going to do is this is going to show the fair market value of all charitable gift annuities, as well as the present value of all gift annuities. And the FASB report requirements vary from state to state, but depending on what software you're using, the software will be able to run the calculations for you for how the states want to see them. And when a gift matures, what we're going to do is we're going to request a copy of the death certificate. We're going to review past payments, and if a payment was made after the gift was matured, it's up to the charity or the nonprofit to reach out and try to collect the distribution that was sent out. And then we're going to provide the executor of estate with a letter of undistributed income and market value at the date of death, as well as review the records for the purpose of the gift. If it was a restricted gift, make sure that it goes to the purpose that it was intended to, or if it was unrestricted or if it's going to another organization, if you're a community foundation, just make sure that the funds end up where they were meant to by the donor. What CTAC does for our clients is we utilize the Berwyn death audit system, and we run that on a regular basis. And what it does is it just, all you put in the information is the first name, last name, date of birth, and social security number of all of your annuitants. And it'll run a report to see if there's any death records that take place. So we're actually able to notify our nonprofits if one of their annuitants has passed away and they possibly didn't find out about it yet. Some common issues that nonprofits run into are later missing payments or incorrect spellings. It's really important that the donors and the annuitants are getting the gift annuity distributions on the dates and in the time frequency that they signed up for in the contract. Some nonprofits, they're just so busy that they forget to mail it out, or it just falls behind in between the cracks. Another issue is incorrect spelling, even if it's just something as simple as Sarah was spelled with an A at the end or just an H at the end. We should really be getting these correct on the information that's going out to our donors, because they do appreciate that. Something else that can happen is your annuitant just goes MIA. Their checks are bouncing back. You don't have a correct phone number for them anymore. You just can't get into contact with them. And when that happens, it depends on what state you're in for what actions you have to take in part of. But for most states, the consensus is that the charity is not obligated to continue making those payments once the annuitants have gone MIA. But if the annuitant comes back, and you're going to have to make back payments to them. You're still going to have to provide a 1099 for that annuitant, even though you're not physically giving them the payments anymore. It's still required to prepare a 1099. And then if you find out in the future that they passed away, you're going to have to go back and adjust or amend your 1096 that you reported to the IRS. When divorce happens between a husband and wife that both have a gift annuity, it's going to depend on the legal proceedings with the divorce. And sometimes what will happen is you just split the gift annuity in half and send half to the wife and half to the husband. And if you're at Sue's office, you might already have the answers, so try not to cheat. But I put together a few questions that I learned these answers at the American Council on Gift Annuities conference a few years ago, and I thought that they were interesting. So I'll give you a few minutes or a few seconds to just look over these questions and see what you think for what's the average age of a gift annuitant, what percentage of gift annuities are one life, what percentage of annuities are immediate, what's the mean or average size of gift annuities, what's the median size of gift annuities, what percentage of gift annuities are funded with cash, and where is it rumored that the first gift annuity was issued to, and bonus points if you can name the year.
Are we going to get treats if we're right, Kristen?
I hope so. Do you have some Twizzlers or Smarties to pass out at the office?
Yeah, we do.
I'm sure you do. If you're at CTAC, you'd have Ghirardelli chocolate. And now that you've had a little bit of time to think about it, the average age of a gift annuitant is 78 years old. The percentage of the gift annuities that are one life are 68%. The percentage of annuities that are immediate are 92%. The average size of a gift annuity is $60,000. The median size of gift annuities is $28,000. And what that just means is the really big gift annuities that are really big to pull the average up to $60,000. And the percentage of gift annuities that are funded with cash is 67% approximately. And the first gift annuity that they say was issued to Yale University in 1831. That's just some fun knowledge to know when you're going around talking with donors, possible donors about gift annuities. And next, we're moving on to charitable remainder trust. And this is just a very basic diagram of what a CRT can look like. It can be set up many different ways, but we're going to keep it pretty basic to begin with. And what a trust is it pays income for either life or a term of years, no more than 20, to income beneficiaries. And once the trust matures, the assets are transferred to the charitable beneficiaries. A difference between CGAs and CRTs is that you can have more than 2 income beneficiaries. And for gift annuities, it's a contract made with one nonprofit typically. With the CRT that you set up, you can have several charitable remainder beneficiaries. It doesn't have to be just one beneficiary. With charitable gift annuities, it's going to be an irrevocable gift. You can, if you're a donor, you cannot say, I no longer wish to have this gift annuity with you and pull it back. With a CRT in your trust document, you can set it up to either be revocable or irrevocable.
On the charitable beneficiary only for that.
On the charitable, yeah, correct. Thanks, Andy. And what we would say is for the charitable remainder trust, we would recommend a minimum size of probably 100,000. If it's smaller than 100,000 that you want to start with, you should probably consider a gift annuity. For who's involved with the CRT, you have your donor, which can be an individual, corporation, partnership, LLC, or trust. You have your trustee, who could be an individual or institution, whether it's a bank or a charity. You have your income beneficiary, which can be an individual, corporation, partnership, trust, or charity. And you have your charitable remainder beneficiary, which can be a public or private charity. Your donor, your trustee, and your income beneficiary can all be the same person if you wish. And your charitable remainder beneficiary and your trustee and part of your income beneficiary can also be the same. You can have your nonprofit serving as a trustee and also as an income beneficiary. The benefits of a CRT is that we talked a little bit about these before, is you can have more than one charitable beneficiary, more than one income beneficiary. It's a good way to diversify your assets. You can fund it with a variety of assets. You help avoid or defer capital gains tax. You remove taxable assets from your estate, and there is a nice charitable deduction. It's a little bit more complex than a gift annuity. With a gift annuity, a donor doesn't necessarily have to have legal counsel, but with a charitable remainder trust, they absolutely will need to have an attorney involved. There's also possibly going to be the hiring of a third-party administrator and an investment manager. And the types of CRTs that you have is your standard charitable remainder unit trust, or CRUT, your net income with makeup charitable remainder unit trust, which is also known as a NIM-CRUT, your net income charitable remainder trust, flip CRUT, and also a CRAT. Your CRUT is going to pay a fixed percentage between 5 to 50% of the fair market value of the trust, and it gets revalued each year. And the remainder interest must be 10% of the initial fair market value. Your NIM-CRUT is going to pay income only if the actual income is less than the stated percentage, multiplied by the trust fair market value. And deficiencies can be made up in later years if the trust income exceeds the stated percentage. So, for example, if you have an 8% payout rate and the trust only made 6% that year, you can only take the 6%. For your net income, it is similar to the NIM-CRUT, but you don't have that makeup account with a net income charitable remainder trust. And your
the flip trust would be, when you have a flip trust, you have the best of both worlds. You start off as a net income trust. Typically, a flip trust is set up when you have a hard-to-value asset. You can contribute real estate. You can contribute different LLC units, something that doesn't necessarily have a liquidity event involved right away. Down the road, you can sell it. And then there's multiple triggering events you can set up with a flip trust. You can set it up for when that property sells, or you can also use this to treat it like a retirement trust, where you could say, we want to keep this in a net income environment until I turn the age 65. The younger of the two income beneficiaries turn 65. You have a lot of flexibility with how you set that up. And then when that triggering event occurs, then the trust would transition from a net income trust where you're only taking income earned and realized from the trust to a standard fixed payment trust where you're getting the stated payout rate every year on the trust.
And then with a CRAT, your unit trust is paying a percentage if it's a unit trust. With an annuity trust, it is paying a fixed dollar amount to the income beneficiaries.
And the important thing to just remember on the types of trust, there's a lot of flexibility you have in how you want to set it up. What it comes down to, what you have over setting up a gift annuity is it gives the donor more ability to, decide what they want to take. Are they looking for a fixed payment every year? Then we want to go with an annuity trust. Or are they looking more along the lines if they want to know, as if they're a little younger, as the assets increase, I want my payments to increase, we go with a unit trust set up with a proper payout rate so it's not too high to cannibalize itself. And if they're looking more to defer, that's when you can move into a net income type trust or the flip trust if they're looking to defer for just a short period of time.
With a charitable remainder trust, you're going to have to follow 4-tier accounting. And what that means is your ordinary income items, your interest and your dividends, are going to come out first. You're going to be tracking the interest, dividends, capital gains, tax-exempt interest, et cetera, separately throughout the year. And then the items taxed at the highest rate is used up for income and then moves next to items that are taxed at a lower rate.
This changes a lot. The IRS changes the rules on how 4-tier accounting gets treated all the time. Recently now they've just enacted a new healthcare tax that went into place for 2013. It's a 3.8% tax, I believe, on any net investment income you earn, and it has a special impact on how the trust treats it. So the easiest way, if you're ever talking to a donor on how taxation on their payments goes, is I always view it, the 4-tier accounting is sort of a worst in, first out environment. You're going to pay out whatever the trust happens to be holding, not even in the current year, but from previous years as well, that's being held in the tiers, that has the highest tax associated with it. That's what gets paid out first. There's no tax the trust pays, and they defer it, but as that income gets paid out to the income beneficiaries, it usually, not always, takes on the highest characteristic tax first, so ordinary income that would be subject to net investment income, and then, qualified dividends will come out a little bit after that. So there's more to it, and that's one of the big differences with the charitable remainder trust over a gift annuity. There's more complexity on how the taxation of your payment comes out, where in a gift annuity you know what your taxes are going to be every year when you set it up. The remainder trust is going to change and be different every year.
And then next we have distribution processing and tax reporting for your charitable remainder trust. And this is all going to fall under the trustee's responsibility, or he can hire a third-party administrator, an investment manager that will help take care of this. Distribution payments, it's very important that they're sending out the correct payment amounts and calculating the correct amount and making it in the appropriate time frame and frequency that's stated in the trust document. And for NIMCRETs and FlipCRETs, it's absolutely necessary to track the makeup account that's going on with your accounting, 4-tier accounting, and then different tax forms that are going to have to be sent. There's your Form 8283, 709, Schedule K1. We're receiving a lot of phone calls right now for individuals that are looking for their K1. Tax season's our busiest season here, so we're right in the middle of the Schedule K1, preparing the K1s and the Form 557, which recently changed big time this year, like Cindy was talking about earlier. And some states require that you register the CRT with the Attorney General, and there's additional forms that you just have to see where your trust is set up for what the states require of you. If you're in California, you're also going to have to fill out a Form 541B, for example. So it's very important that everyone that's involved with the CRT understands the different compliance issues and what the different states require and the different types of trusts, what they require.
When you look at the Trust is unique also in the sense that every year you have to value your trust. Unmarketable assets, so when you're in that flip provision, if you set up a flip trust in your real estate, an independent special trustee or some sort of expert should be appointed to set a value to the trust each year so that the IRS, you have a basis for how you got to the makeup account or your unit trust amount payment. Compliance issues with the trust data as we deal with it are there's specific types of investments that trust can and cannot make. You can't have a charitable remainder trust can be set up many different ways, and it probably gets too deep to delve into too many intricacies that a trust can get set up. But ultimately, the charitable remainder trust is subject to several of the private foundation rules, which are 4942 to 4946 of the code, where you can't have excess business holdings and jeopardizing investments. And it's one of the issues where, if done correctly and you talk to the donor ahead of time because they want to invest in a specific closely held company, that they would have excess business holdings. They can be done inside the trust. You just have to know it ahead of time. So there's a lot of compliance or knowing what the donor wants when you set up the trust initially. And then the specifics of you can never have any sort of debt inside your trust. If you put in real estate, you can't, and it's your primary residence, the individual, the donor cannot live in it. If it was a vacation home, you can't live inside your trust. So it's the specific compliance rules that somebody should be put in place to understand it when you initially set the trust up.
This is just a sample annual report that we send out for our institutional clients that have charitable remainder trusts. And you'll just see basically all the information that's happened throughout the year here. This one, for example, is a net income with makeup. It's a NIMCRUT that has a payout rate of 8.6% quarterly. Here's a breakout of the assets that are inside the trust. Here's past distributions that have gone on back to 2001. You can kind of see how that looks, as well as the market values of the trust throughout the years. And then over here you'll see just all of the money that's inside the account, the interest that you earn, the dividends, non-taxable income, business income, your disbursements that went out to your beneficiary, if you need any charitable distributions. It tracks the asset management and administrative fees, your capital gains, and then here's your four-tier accounting that we were talking about before, where any types of worst in, first out. You have your ordinary income, your capital gain, your tax-free income, and your principal. And then here's a breakout of the remainder beneficiaries, the charitable remainder beneficiaries. This one is just going to one organization, but if you had it going to 5, it would obviously be broken up equal, depending on the payout for the charitable beneficiaries and the percentages. And then just here's some more information that you're probably going to want to see. Some trustees manage the investments themselves, whereas others, they hire an investment manager. And you can probably talk a lot about this and have a whole separate section on the investment management. But basically what your goals that you're going to want to have is, if you have a CRAT, your investment planning goal should be that you want to earn enough to pay the CRAT without using up all of the trust, any of the trust principal. And other goals that you should have in place is to grow the capital of the trust to keep pace with inflation and provide value in the assets of the trust so that the charitable remainder beneficiaries will have something to take away from when it's all over. If you're hiring an investment advisor, it's very important that he or she is familiar with investments and with the charitable trust and how they work. Some people will actually send out requests for proposals, just asking very specific questions to evaluate everyone on a fair playing scale for their investment management as well as their administration.
I sort of jumped ahead of the game a little bit here to talk about unrelated business taxable income and self-dealing. These are the issues that you get into, and they really come from the compliance of the trust and what the trust can and can't do. The most important things to always understand if, as a nonprofit, you're setting up a trust and becoming the trustee are these two issues, because if you don't follow the self-dealing rules, the IRS has the ability to not only penalize the trust itself, but If you continue to not follow it, it could be levied on the trustee, and that can be levied up to 100% of the issue at hand. So if you have something that you've been doing incorrect from the beginning, the penalties can get very onerous. Now, it's something that, set up properly, very rarely you have to worry about, but it's one of the issues that you always want to pay attention to in setting up trusts, and those come along the lines with, as I was talking about, is not living inside the trust, not having a trust. Once you donate property to a trust, you can't have any extra benefit from that property. Even if it's artwork, technically, we have clients that have donated art while it's being sold. It shouldn't be hung in their house. I mean, they would be, indirectly deriving enjoyment from viewing that particular piece of artwork. I mean, how does it get found? Very rarely. I can't see how the IRS would see that, but those are the types of issues you always want to pay attention to, so you do not run afoul of the self-dealing rules. And there's many others, and those are the type of things that go a little bit beyond the basics discussion of charitable remainder trusts, but it's something that you put out there, and as you get into unique cases in a charitable remainder trust, it's good to talk to an expert if you have unique situations like that, so you don't run afoul of the self-dealing law that the IRS has.
Yeah, so just two quick questions for trivia again, and then we're basically going to be wrapping this up. What do you think is the most common type of CRT, and what was the most popular charitable distribution purpose in 2012 for CRTs? I'll give you a little bit of time to think that over. And the CRT is the most popular.
CRT being a standard charitable remainder unit trust.
It was 86% of Form 557s that were filed. And the number one charitable distribution purpose was for public benefit, and that was at 56%, I believe. And then education and human services came in second and third. And then lastly, just some resources for you to go and look at is the CGA website. If you're interested, obviously, in gift annuities, there's a lot of good information on there. Partnership for Philanthropic Planning, they also have a resource section that will go into your gift annuities, your trust, if you're interested in donor advised funds and other plan giving vehicles. Plan Giving Design Center, they have good case studies if you're looking for more complex information. Very good articles out there that you can search and look at. And then this is actually something that Sue's organization provides. If you have a donor that's interested in setting up a gift annuity or a charitable remainder trust, all you do is you come to her website and click on the link for Gift Illustrator, Gifts that Pay You Income. You want to calculate immediate payments for a gift annuity. So we can pick our age. It can be 80. We want to give $29,000, and it'll show you. This is a very basic, but it'll show you the potential charitable income tax deduction that that donor would get, the annual payments that they'll receive for lifetime, and the amount that's going to be given to charity, that's expected to be given to charity. And you can also do the same thing for a CRT. And it'll just give you the same information. Now, Sue, if you guys have any questions, or if anyone else has emailed any questions over.
Kim will pull that up. Yeah, at this time, if anybody has questions, both here at the office as well as on the webinar, a couple of things while people are typing in questions. As you can see, CGAs and CRTs really are not difficult to do. A CGA doesn't even require the involvement of a lawyer to get that basic contract set up with your donor. CRT does require some detail and some professional advice as you move through that. But the reason that I wanted you all to join in on this webinar today is to know one thing that I didn't know as a frontline fundraiser when I started, is that there are groups out there that can take away the administrative hassles of offering these gifts. And many boards will say, yep, it's a great tool, but we're just not doing it because we don't have the personnel. Well, I'm here to tell you today that there's somebody that can help you do that, and that's CTAC. There are other organizations out there, some banking industry people do this, but as you look at the kind of tax reporting that's required both for CGAs and CRTs, it's important to understand that that becomes your responsibility as the administrator. If you hire someone to do that, they take care of that for you. That's a really important facet to think about as you want to allow those to be offered to your donors. The other thing that Andy kind of touched on too is, you know, Kristen even said when you hit about $100,000 at a CGA, you might want to look at a different option, and maybe that's a CRT. Really important that you understand, whether it's a CGA or a CRT, what is it your donor hopes to accomplish by making this gift? And often understanding that a little bit better will tell you what direction to go. Because we have done CGAs in the excess of not only $100,000, but in the excess of $500,000, because that best suited the needs of the donor. So really important to take the time and be attentive to what it is your donor is attempting to accomplish, and then along with that amount, you'll better understand which plan giving tool to bring to the table for them. We had one question from Jake that asks, will a PowerPoint of this presentation be available? The answer to that is yes. There will be a PDF of this presentation that Gina, our marketing person, will send out. You'll also have the link so that if you want to go back and listen to what Andy and Kristen have talked about today, you'll have the ability to listen and see the conversation as well. Any other questions? Got a couple of reminders. Kristen touched on a couple of them. The American Council on Gift Annuity Conference is April 9th through the 11th out in Baltimore. This only happens every other year. So if you're not fortunate enough to be going this year, make sure you get it into your budget in 2016. A great opportunity to really understand one of the most basic plan giving tools that there is in the industry, and that's a charitable gift annuity. The second one coming up is called Advisors in Philanthropy, or AIP. That occurs April 23rd to the 25th in Chicago. This is a really unique organization in that you'll have a lot of professional advisors, lawyers, etc., but you also have nonprofits that are starting to attend this. We have a webinar coming up in September that's going to talk about the CAP designation, which is the Chartered Advisor in Philanthropy. What is it and why should you achieve it? That designation actually came as a result of the Advisor in Philanthropy membership group. It's just a wonderful group to be a part of. You don't have to be a member to attend that. It's centrally located, always real close to the Chicago airport. And this year they've added a panel discussion on Wednesday afternoon. I'm real excited that I'm going to be a part of that panel. That is an additional $50 fee to participate in that, but it's from 1 to 5 p.m. on Wednesday. I think it's going to be really beneficial on relationship buildings in not only the nonprofit industry, but in your professional advisor industry as well. Our next webinar will be April 17th from 4 to 5 p.m. Central Standard Time. The topic is going to be how to use charitable tools to reduce income tax in a high income year. Again, reduce income in a high income year. You may have donors that you come across in 2014 that for whatever reason, due to a stock buyout or a large payout if a company has been purchased, etc., that may suddenly be faced with 2 or 3 times their normal income. How can you, as a nonprofit professional, help them better understand what some of the opportunities might be for them to have some charitable tax deductions? And so Walt Mosier from Severson Strage and Company will be conducting that one, and that's from 12 to 1 Central Standard Time, and we'll send out some reminders on that. We'll look again. We don't have any questions online. Anybody in the audience here have any questions they want to ask?
sorry, Susie. 10 versus 4 to 5.
Yes, 4 to 5 p.m. Central Standard Time. September 18th is 12 to 1. Thank you, Kale. Well, with that, I want to thank Andy and Kristen for joining us today from Cleveland. And to all of you who signed on in the comfort of your office, know that you are always able to do that. We love having you be a part of these webinars. We will have the April 17th one, and then we take a little bit of a hiatus from May through August. We may throw a couple in there this summer just to make sure everybody's staying on top of their game from an educational standpoint. But until next month, again, thank you for joining Charitable Giving Resource Center. If you have questions, need advice, know that we're always there to answer the phone and answer the questions. Kristen or Andy, anything you want to add?
No, thank you for having us.
Absolutely. Andy, I understand you're leaving us and you're offering your expertise to the Greater Cleveland Sports Commission today.
Yeah, I'm on my way to that board meeting next, absolutely.
Well, thanks for all that you do for the philanthropic community. We really appreciate it.
Thank you.
All right, everybody, take care. Have a great rest of the week.